Hello, and welcome to HUB24's webinar on investing for the future with the clients of the future. My name is Paula Farrell and I'm the State Manager for New South Wales here at HUB24. And today I'm joined by three guests who are leaders in ESG. And they're going to discuss trends we're seeing in ESG, both in Australia and globally, and help us understand what that means for advisors. So to introduce our guests, Erica Hall, wave Erica, is an ESG Analyst for Morningstar Australasia, wholly owned by Morningstar Inc. She is responsible for conducting qualitative research on Australian and New Zealand managers and their funds. Prior to joining Morningstar in 2017, Erica started a career as a money market dealer and has worked in a variety of roles within financial services, including strategy, product, and client relationship management. Then we have Leah. Leah Willis is the head of client and relationships at Australian Ethical Investment, Australia's leading ethical superannuation fund and investment manager with over 8.37 billion as at the end of December 22. Leah is responsible for client relationships across Australian ethicals intermediated channels, including financial planners, researchers, consultants, and mezzanine investors. And Leah has more than 25 years experience in financial services distribution. And then lastly, we have Fiona Thomas. Fiona has 20 years experience in varied leadership roles across financial services with Macquarie Group and Bendigo Bank and other boutique businesses before joining Eth Invest as a financial advisor in 2016. In 2019, Fiona took the role of General Manager at Eth Invest and is passionate about helping clients invest in line with their values and see more capital mobilised for good. So we'll kick off with the questions. And Erica, if I can start with you, please. ESG means different things to different people. Can I ask you to help us understand the range of motivations and approaches to ESG and take us through some of the trends and insights that you're seeing?
Perfect. Yes, so it is a very large cohort of approaches that can be taken when investing sustainably. And we sort of split it up into two things. Are you looking to mitigate risk or are you looking to actually have a positive impact? And I think in the past, it was all about sort of mitigating risk and sort of measuring those material risks and trying to sort of cut them out of the portfolio. But more and more, it's becoming actually investing to make a positive impact. And so we've tried to build a framework to help sort of have those conversations, because as an advisor, if you're talking to your clients and they say to you, I'm interested in sustainable investing, that is just the starting point, because there are so many more questions you need to ask to really understand what it is your clients mean. And so you can align their values to the underlying investment. So at the most simple end of the scale, if you want to mitigate risk, you apply exclusions on sort of negative product involvements like tobacco, alcohol, gambling. And there's a lot of rules-based strategies, passive strategies that will do this for you. And then, there's a whole sort of, a range of approaches, and they're not necessarily mutually exclusive, which increase along the sort of spectrum from limiting ESG risks, seeking ESG opportunities, targeting sustainable themes like climate change, or actually assessing for impact and investing in those funds that are actually investing in the sort of cutting edge technology and solutions that are going to help build a better future. So it is a really nuanced space, and that sustainable investing is very much an overarching term.
Yeah, absolutely. Thank you. That's a really good overview. And Leah, I'm interested in your thoughts around the increase in accountability companies have for not just reporting on ESG measures, but the impact and the outcomes that is changing the conversation potentially you're having with advisors and that they're having with their clients.
Yes, no doubt there's this rising sort of social consciousness in society all around everything we do every day, but that has tipped over into investments. And I guess just to provide some context to that consciousness, responsible investing as benchmarked by RIA, which is the Responsible Investing Association of Australasia, now makes up about 43% of all totally managed assets. So from an advisor's perspective, this is rapidly becoming mainstream and is growing every year. So there's no doubt that there's top-down pressure on companies and managers to report on their sustainability metrics, both from an environmental, social and governance perspective, but there's also this bottom-up demand being driven by consumers. Consumers are no longer willing to invest just at just for returns without any consideration of the potential risks on the environment, on animals, on the planet, on people, such as human rights and supply chains. So there's this top-down pressure and bottom-up pressure. Some of that has been exacerbated for advisors in the last little while with most of the major bodies such as the SEC, ASX, ASIC and APRA all coming out with some kind of guidance around greenwashing and ensuring that as this pool of responsible investing grows, as the demand grows, that products that are labelling themselves to be responsible or provide sustainable outcomes are actually able to measure the intentionality of what they're trying to achieve versus the outcomes that they actually produce. And I think that is one of the most important takeouts of responsible investing for the next decade for the industry, but also for advisors, is when you're looking to align a client's values with their investments, what are you getting, the transparency of what are you providing to those investors and making sure they line up, but then also what are the outcomes? How do you measure the impact or the success of those recommendations and the products that you've provided to the clients in terms of, have they delivered on the expectations that the clients actually expected? There's some reticence in the advisor market around how do they do this, and we can go into that in more detail, but also the perception of responsible investing versus mainstream. Does it stack up? Is it something I really want to engage in? Will it provide both the financial outcomes and the values alignment that perhaps our investors are expecting?
Yeah, no, that's fantastic. And Erica, maybe a question for you, if I can, just off the back of that comment by Leah. There's the myth out there that it's a trade-off, ESG versus performance. Can you talk to that?
Yeah, so every quarter we look at inflow data, funds under management, performance in relation to sustainable investing. And one thing that we capture is the performance, and the long-term performance has been actually really good. And what the data shows us is that you don't necessarily have to give up returns to invest sustainably. And that's really good because sustainable investors do care about performance. They don't want to invest and make a loss. They do want to make a positive return, but they really care about how that performance is generated. And so what we were able to sort of find in the last report that we did was in the 3 years, 56%, I think it was, 56% of sustainable funds were able to sort of beat their Morningstar category peer cohorts. So when I'm saying Morningstar category peers, I'm saying, are you an Australian equity manager? Are you an Australian fixed interest manager? We're not actually delineating between sustainable at this point in time from a category perspective. And despite that, the sustainable funds actually kept up or slightly actually outperformed their broader market peers. Same thing again in the 5 years, slightly less. It was 54% were able to outperform the broader market. Now, in the short term, in the last 12 months, it has been really challenging for sustainable investing. And so only 35% were able to outperform their peers. But you've got to kind of look at what's been happening in the last 12 months. We've had high inflation, we've had a rising interest rate environment, we've had the conflict in the Ukraine, we've had really high energy prices, and sustainable investing does tend to have particular sectoral biases. So typically lower weights to energy, for example. Energy was the standout performing sector in 2022, and so by not holding that, immediately put the sustainable funds at a disadvantage in that short term. So, just this short-term cyclical pressure was not, was not in the best interest for sustainable investing for the last 12 months, but the long-term trends stack up really strongly. Some other things, so for example, the flows are really, really strong in sustainable investing as well. So we just see that they have been enduring despite market conditions. So even in tough market conditions, there are positive flows going into sustainable investing. And so the retail fund flows are consistently increasing, and they're around 42 billion currently here in Australia. Some other things that we notice is that there is definitely a preference for active over passive in this space. So 72% of sustainable investments are in actively managed funds. So, there's the other thing that we're also noticing is that whilst that we do, I can't really speak today. One other thing we are noticing is, whilst markets can be producing difficult returns, in the broader market, we'll see massive outflows. So I think in Q2 and Q3, we saw billions of dollars of outflows in the broader investment market, but sustainable funds still had positive flows. So we sort of go, why is that? And we think it's because it's not just about performance. Yes, performance matters, but sustainable investors are more patient. And so they are investing aligned to their values, and they are really clear about why they're investing. And so they're prepared to sort of play the long game, and they therefore tend to have stickier money, which I think is really important from an advisor perspective to be aware of.
That's great. Thank you, Erica. And Fiona, we'll move on to you. And I know from our conversation previously, you'll echo a lot of what Erica just spoke to there as well. So
Absolutely.
Really interested to know from your perspective, how do you go about having a conversation with your clients or your prospective clients around what does ESG mean to them? So it's your initial meeting with the client. How do you have that conversation, and what are you finding?
Well, that's something that's changed over the years. So the business I'm talking on behalf of today, Invest, has been going since the late 80s. So obviously we've done different things in that long period, and that's varied from more of a tick box approach, where we've at times presented clients with a list of things that they want to avoid or promote within portfolios. What we found with that is it does tend to lead the witness, so to speak. So people will see a list of tick boxes and feel that they need to tick everything. So our current approach is actually to have a far more open-ended conversation. So we do have questions within the fact find for retail clients, where we are asking, are there particular areas you're interested in, and are there particular areas that you would like to avoid? So rather than giving them a list, we want to hear that in their own words if we can. And we ask, are there sectors, are there activities, are there different things that that they want to have or not have in the portfolio? And what we're seeing is really environment and climate change related themes are the strongest ones. Really lines up with what Erica and Leah have already said, but things such as, I guess, tobacco and gambling, fossil fuel extraction, they're actually, for the clients that we work with, they're more like hygiene factors. They're a no-brainer. You wouldn't have those, and it's actually it's the more detailed and more, I guess, there's a lot more issues in the world than excluding tobacco, for example. So broadly, I think the shift's been from a time when it was about exclusion of industries or companies to trying to understand, if possible, where would you like to see your money going? Are you particularly interested in healthcare? Is social justice important to you? And it's not always that you can match an investment exactly to a list of things that a client might talk about, but at least if you know where they're coming from as you see opportunities come about, or if you see a company within a fund that you think, oh, actually that client, I know that client really well, and that's going to be something they'll be interested in, you can highlight it in your discussions with them, or you can use exclusions if you're using SMAs and things like that to avoid things.
I might just also add there in terms of climate. So certainly our data has shown that climate is a mega theme globally, but definitely Australians care deeply about climate change and investing aligned to sort of improving the climate. So with the data that the assessment that we undertake on a quarterly basis, we have found that the most common sustainable development goal that the funds are sort of adhering to is Sustainable Development Goal 13, climate action. So that is the priority. We also do a global report just on investors' interest in climate. And we found globally, so we split up the regions into the US, Europe, China, and then the rest of the world. And in the rest of the world category, which includes Canada and others, Australia was the leading investor in climate solutions. So it is very much something that Australian investors they're putting their money where their mouths are, and they are investing to support climate change.
Thank you, Erica. Sorry, Leah, were you about to say something?
Paula, I could probably add a couple of things to that, both from the RIA benchmark report again, but also we do an annual report with Investment Trends, which is the ESG report, which they instigated a couple of years ago, where we actually do a pulse check of both investors and advisors, and there's some interesting stuff around climate. Once again, I would echo Fiona's and Erica's points that climate is not just the #1 social issue globally that we're contending with, but for consumers, it is where the demand is around investments as well. So the consumer searches that happen on the RIA website each year, they benchmark in their report to give an indication of what consumers might be seeking out when they are looking for responsible investments. And overwhelmingly, it was around sustainability. So I'll just quote some of these things, and happy to share these slides afterwards as a follow-up. But things like renewable energy and energy efficiency, sustainable land and agriculture, sustainable water, social and sustainable infrastructure, impact investment. So you can see that sustainability, so that more forward-looking approach rather than just blunt negative exclusions, is certainly where consumer interest lies. And in the Investment Trends report, we found that about 42% of investors are currently engaging in ESG or responsible investing in some way in their portfolio, but another 33% are interested in engaging and are actually likely to seek advice. So that's a really key takeout for advisors. We know that consumers, where issues are complex, where they don't think they can navigate options in the marketplace, they will seek out advice. And so that's 75% of investors that were surveyed that are either investing or have an interest in responsible investing. And the underlying issues that they were most passionate about, which they named, were ocean conservation, preventing climate change, renewable energy, sustainable agriculture, and reducing carbon emissions. And I wanted to make another point from an advisor perspective. We now have the Teal government, so the commitment by the Albanese government in terms of net zero for Australia, which had been outstanding for a very long time, and there was a lot of pressure from the general population to make movements, and they spoke with their feet during the voting process. And we're still seeing that Teal swing continue in terms of its uptick in the Australian marketplace. But also, I think we spoke in heading into this webinar around sort of that transition of wealth that's occurring. So for most advisors, they're advising the baby boomer population in the most part right now. It's about 25% of the population, but they do control the bulk of the assets, around 50% of the wealth assets in Australia today. And that's expected to be $3 trillion that's expected to transition to the next generation, millennials, but even beyond that in the next sort of 25 years out to 2050. So I think that the latest report is around 224 billion per year that will actually transition. So that's a weight of money. And while our report didn't necessarily say that millennials are the most passionate about responsible investing, it actually was something that was in high demand across all different cohorts. But we have no doubt we all understand the passion, the climate urgency in the millennial, but even the younger generations, in all aspects of their life, including employment. They're seeking out purpose and values alignment. So this will no doubt continue to drive demand of responsible investing, and in really pointed issues like animal cruelty and welfare, human rights, social equity, and supply chain. So I think while climate is the overarching issue today, I think the complexity of the social issues that these younger investors will demand is possibly complex, possibly daunting for some advisors, but also really exciting in terms of where investments might go in the next decade.
Yeah, thank you, Leah. It's a real challenge for advisors to be across it all. There's so much to it. Fiona, really interested in your thoughts off the back of that. Like how do you as an advisor stay across it all? How do you get to do the research you need to do to be able to have informed conversations?
So because we specialise in this area, we're probably a bit different to a lot of firms that are trying to handle ESG inquiries from clients or prospective clients. But at different times in our history, we've brought in third-party research, and there's now more than ever sources of that third-party research which are probably accessible through the same place advisors are getting their, you know, financial metrics and things for. So, you know, your Morningstar, your Lonsec, your, you know, wherever that research is, all of those providers are also looking at the sustainability aspects of the products that they're rating. We have an in-house team, but I would say you don't need to have an in-house team as much as you did maybe 10 years ago, because there is a lot more data and a lot more information available. The other, you know, there's groups such as the Ethical Advisors Cooperative that we're part of, and that's a very low cost way of building your own knowledge and connecting with other advisors across the country that are operating in this space. Using models, using screened ETFs, you don't need to know everything about every product and every social and environmental issue to start having conversations with your clients. I think clients really value that you're genuine, you're honest about what you do know and what you'll go away and investigate. I think some advisors probably feel a bit nervous about even asking the question because they don't know what level of knowledge a client or prospective client might have on the issues, and they don't want to feel less expert because we're used to sitting behind the desk and being the expert. But in these kind of ESG issues, I don't think many people expect you to know everything about every issue, and it's more about that genuine willingness to look into things and to understand what the client's values are and what they really care about.
Yeah, thank you. Because it's very much about, you know, values alignment, but having the investment expectations met as well. So Erica, in terms of, I know you just trying to speak there, is there anything you wanted to add?
Oh, I was just thinking in terms of the data, look, definitely more data is coming through as the industry evolves. And I think particularly, you know, there is a lot of, you know, improving climate data. Obviously, the ASX listed companies are expected to identify their climate risks and report on that on a voluntary basis. Leah, you touched on the fact that, you know, we now have legislation in relation to climate and, you know, greenhouse gas emissions, and a commitment to achieve net zero by 2050 by the recent government. And there is also a Treasury sort of consultation paper at the moment, which is looking to sort of standardise disclosure requirements here in Australia relating to climate. So all of this is happening, and so you can see where it's heading. This is, you know, this data is going to get better and better, and people, you know, investors are going to want more and more, I guess, information from their fund managers in relation to these issues, and therefore from advisors as well. You know, so I think what I'm hearing is advisors are coming to, what I'm hearing is investors are coming to advisors and saying, hey, I'm really interested in investing sustainably. And then the advisor is going, okay, what do I do with this? Which is why we sort of talked at the start in terms of the framework and really trying to dig underneath their clients' requirements in terms of what do they mean by sustainable investing. And then, you know, it's then trying to sort of find that sort of alignment to make sure that there's no misalignment of expectations, because we talked about greenwashing as well. And so I think the Investor Trends report, correct me if I'm wrong, Leah, mentioned that greenwashing is one of the biggest concerns for advisors. So they've got a client that's come to them, they're really interested in sustainable investing, and they go, okay, how do I unpack this? What do I do? And I don't want to be in a situation where I've provided, you know, the incorrect advice or suboptimal advice. And so the data is going to help you. The information is getting better and better. Understanding the client is going to help you. So by asking the right questions, and then I guess, you know, what's happening from a legislative perspective and a reporting perspective is going to help you going forward as well. But I think my point is that you can't ignore it. It's not going away. You can see where it's headed, and you know, there is going to be so much more information available to investors and to advisors, which is only going to help in aligning people's values with their investments.
Yeah, I'll jump in there and say, actually, we're approached every week by people who have tried to have a conversation with their existing advisor about their values or an ESG concern that they've got, and they haven't been able to get to the level of comfort that with that advisor, and so they're looking around. And you know, that's great for us, but it's not great for for advisors who I guess stick their head in the sand and say this isn't something I need to consider.
Yeah, no, that's yeah, I get that. And what does that mean in terms of the relationships then that you're developing with those clients, Fiona? Are they different to the more traditional relationships you might have experienced in the past?
Yeah, look, I think that it does allow for a deeper relationship with clients, because the things people care about, of course they care about meeting their financial goals and looking after their family and a range of other things, but the things that people are passionate about or care about, and that you connect with them on, makes that a deeper relationship. They are stickier clients. They are more focused on what's my money doing in the world, rather than what's my money doing for me this quarter or this year. They do have that longer term perspective. And we've just we did a client survey at the end of 2022, probably the worst year for most of our portfolios, because we do have a lot of exclusions around oil, gas. Most of our clients are not in the energy stocks at all. We ended up with a net promoter score of 76, which is really off the charts for financial services. And one of the top reasons that people gave about why they like what we do is that they like that we understand them personally, that we know them properly. And so it does see you through those periods where, long-term returns for responsible investment absolutely outstrip traditional, which is what we call unsustainable investment. But in the short term, you're going to be out of sync in periods where there's a war in Europe. There's no doubt about it, and there will be other things that come up. But when you've got that deep relationship with the client, that is just not all about what's the return that you produced over the last 6 months or 12 months, then that's a really precious thing to have with your clients, I think.
And Paula, I could probably add to that from that report, and that's obviously a fantastic result, Fiona. Congratulations. And we do find the same thing from our brand perspective as well. So while most super funds have sort of negative NPS or quite low NPS, we actually have the highest and continuing to be extremely positive NPS. So there is sort of what we call sort of a halo effect when you do understand and align your investment and outcomes with an investor's sort of expectations around sustainability. But I would just quickly quote from the investment trends report as well, that we did note a really strong uptick in the latest report. So 1 in 2 advisors are now providing some kind of ESG or responsible investing advice. They still admit that it is a reasonably small part of their book, and they're not necessarily proactively engaging, but they're certainly engaging as clients are coming through the door and demanding or asking the questions. That's up from 1 in 5 in 2016. So there's been a significant uptick in terms of advisors embracing responsible investing into their advice processes and recommendations. But some of the key takeouts for advisors that might be thinking about this space is the advisors that are engaging in this space noted things like better client engagement and an enhanced value proposition, attracting more clients, retaining existing and building better rapport with existing clients. So all the qualitative things that you would expect out of having a more personal conversation around values, not just financial outcomes, and obviously benefits longer term from a business perspective for advisors. And that's probably going to be important given the context I said about this transition of wealth as well. And we certainly are seeing and hearing more advisors, not just in the private wealth space, but right down into sort of mainstream and IFA, starting to engage in family and intergenerational wealth conversations and making sure that they have engaged with that next generation before that sort of transfer does occur, given and understanding that the demands and needs and expectations of that next generation. Interesting, some research that we were doing from a strategy perspective internally recently is with the higher incidence of wealth in Australia, we've seen more family offices set up in the last couple of years than previously. Of all those family offices, more than 50% now have foundations or private ancillary funds. So philanthropy is increasing as a trend in Australia. And then interesting in terms of corporate giving. It's not just your traditional corporates that are dominating this space anymore. There is this really strong cohort of purpose-driven corporates, like the likes of Atlassian, Thank You, Who Gives a Crap. You know, businesses that came from the B Corp kind of sort of part of the market and have actually now entered the top 50 corporate givers in Australia. So there's this overwhelming, I guess, realization that purpose and values right across everything we do, including employment, including the way we structure our investments, is really becoming quite significant to people.
Yeah, there's some really consistent things coming from all three of you during this webinar. And it is, so just going back to the challenges for advisors, given as you said, it's just more and more advisors are having these conversations now. What are their investment options? What's available to them? What are the different options they can consider in terms of aligning the investments to the client's values? I don't know who wants to answer that question.
Can I just give an overarching, because I'm not giving advice, and so Erica and Fiona are much better equipped to provide guidance to advisors. But I mean, I say this on panels quite often. After 25 years in the industry, I've seen the evolution of asset allocation, portfolio construction, and every couple of years, advisors will need to embrace a new concept, I guess, in their advice recommendations and in that process of constructing investment portfolios. And look, I don't see this as any different. This is a thematic, and there's an investment thesis, I guess, particularly given the decarbonisation theme that we've been discussing and the transition that not just the Australian economy, but the global economy needs to undertake over the next couple of decades. There are portfolio implications to that, but I would just say that advisors don't need to know everything. They don't need to throw out everything they've been doing and starting again. You know, there's a transition and an evolution that portfolios can go through. And from the investment trend survey, we saw that advisors are equally split across. I'll include it into my mainstream portfolios as an investment thematic and start embracing different options and sort of including that within my mainstream. So I'm taking advantage of that investment thematic. I'll actually go ahead and build RI models because I want to be ahead of the curve. I want to be prepared, and I want to have a solution when clients do walk through the door. But, you know, that requires a scale maybe that not all advisors necessarily want. There's off-the-shelf multi-asset balanced funds such as we offer, but increasingly the MDA space. So Morningstar and other providers providing those off-the-shelf solutions that advisors can incorporate into their practices. And that was sort of evenly split across the advisors that were embracing RI.
I'd say
you don't have to do everything, do you?
No.
Anything that Fiona you're looking to add on there?
I would say that there's just so much product available now. So 15 years ago, Invest built direct share portfolios and you know, put together, you know, across all asset classes, almost all direct investments, because there wasn't the product there to choose for a client that had ethical screening. I mean, I know Australian Ethical was there, and you know, we've got long relationship with Australian Ethical, but there's now, so our approved product list has I don't know, probably 10 different really high quality international share funds that fit what we call our benefits to society classification. So we have 4 classifications from harm, avoid harm, benefit, and then contribute to solutions, being at the more pointy end of impact. And even when I started at Invest, I think we had 3 or 4. It's now at 10 in international equity. So there's a lot more options for advisors to build models, to build SMAs. There's indexes that are screened really well. You don't have to make a bespoke portfolio for every client that comes in, picking individual investments to meet their absolutely detailed requirements. If you have a clear articulation of how you rate things, which provider you're outsourcing that to, and why you have confidence in them, I think that's enough for, you know, 99% of people. Yes, there's people at the far end that will need something more bespoke, but your average retail investor doesn't fall into that category.
Yeah, and I'll just add that we look at product, so product launches and the number of products that are available in the market. This is on a retail, so this is funds and ETFs. 190 as of Q4 2022. We're sort of seeing consistently new products being launched to market in this space as well. I think the other thing to note is in the past it was very equity heavy because that was sort of the most transparent and most available data set available, but we are getting much more information now on other assets, like over-the-counter assets like bonds, for example. So there is, yeah, it's come a long way. It's evolved pretty rapidly, and so there are, you know, a whole heap of different asset classes available now, including those, you know, multi sort of asset products as well, like your balanced growth, high growth, etc., in a sustainable, you know, framework, which is fantastic. So there is plenty to choose from, maybe even too much, you know, overwhelmed by choice. And I think also, yeah, would echo that we're definitely seeing more options available from a sort of a broad market, sort of standard model to you know, dealer groups and advisors also having a sustainable model alongside that to choose from.
That's great, thank you. So I think we're almost on time. There's been such great discussion and insights, so thank you so much. Maybe if I can try and summarise the top 3 takeaways out of today, and if you don't agree with my top 3, I'm really happy for you to share any other points you have. So performance, I think, is a really big one. So I think it's definitely what I've seen, and I know, Erica, you have some data on this as well, that you know, contrary to what people think, you don't have to trade off performance. So that's really important. Sustainable investing is here to stay, as you said, Leah. It's not going anywhere, and advisors increasingly are realising and are making those changes to their business, which, as we've heard from you, and especially from you, Fiona, that's great because it makes for a deeper relationship that you can have with your clients. So that's definitely, I think, the third point, that deeper client relationships, where it's not just about the investments and the performance. You can really align those investments to your clients' values, and that makes for a really richer conversation, and shifts the conversation, I'm sure. So any other takeaways that anyone wanted to share?
I think the stickiness of the investments for, you know, when you're investing sustainably. So Fiona touched on that. Certainly our data demonstrates this as well, that when you're investing beyond performance, you're investing aligned to your values as well, you can be more patient because you've got complete clarity on why you're invested. And so as a result, sustainable investors tend to sort of hold the course even in times, you know, of market volatility. So, you know, again, I think that's a really important sort of phenomena to be aware of.
Absolutely, thank you. Well, thank you so much to our guests today, to Erica, Leah and Fiona. Really enjoyed hearing your insights, and thank you for sharing your really deep knowledge and experience in this space with us. Please contact myself or the HUB24 BDMs, or you can contact our speakers directly if you have any questions. I know that we'd all be very happy to answer them for you. And thank you for your time today. Goodbye.
Thanks so much.